Markey. This discussion is designed primarily for our clients who have taken low stress trading CD course to expand upon the primary timing methods taught in our course. The general public may find this video helpful in making their timing decisions, but it assumes you have some working knowledge of supply and demand charting techniques. Our goal is to expand on the basic supply and demand charting tools to take advantage of stocks that are in major moves up or down but have not made new supply and demand breakouts in a long period of time. We will use an example from a recent trade that we have done to illustrate the techniques that we have used recently and expect to use in the future in our newsletters. The company is SAP AG, symbol SAP. This stock has had several ascending double top breakouts since the year started. The first ascending double top breakout occurred in April, as indicated by the green oval. The second occurred in May, and the third and longest running was in July. But if we look at the chart, we see that there is a column of O's for each column of X's, which are highlighted by the red oval. We generally have not tried to place a position for these consolidation moves. So for each breakout, there is a consolidation. And what we want to do is to try to take advantage of some of these consolidation moves. But consolidations are not the only area for improvement. We want to profit from long continuous up moves as well. Because SAP has had a long profitable run, it is reasonable to expect that the stock could consolidate back down to near $39 or $40 a share sometime soon. For our upgraded analysis, we will use a conventional chart. We have been experimenting with the 50-day moving average and volatility indicators on several stocks this month, some of which we featured in our newsletters and some of which we traded outside of the low-stress trading portfolio. They all were found using supply and demand scans as they are taught in our CD course and had current buy signals in effect. All of the stocks we traded using these enhanced techniques are profitable at the moment, and I expect that we will have a 100% success rate as Expiration Friday is only a week away. We use several different trading strategies to see if this concept will work for a variety of techniques. There is a large amount of information in this chart that is easy to see and interpret. We will discuss volatility squeezes first. Each green oval highlights a volatility squeeze. When a volatility squeeze is followed by a volatility expansion, we can determine the probable direction of the stock price by observing if the stock is favoring the top of the band or the bottom of the band. In all three cases on this chart, the price is moving towards the top of the band as the expansion starts. Notice that there is a significant price move accompanying the expansion, and that we are in the early phase of a new expansion right now. That's on the far right. This is equally as good an indicator for downward moves as well. When we add the 50-day moving average as a secondary indicator, we get a strong confirmation that we have a buy signal. You can see that the stock price crossed the 50-day average right in the middle of the volatility squeeze, as shown by the green arrow. The blue arrow shows that the stock retraced to the 50-day average and gave us a second buying opportunity about a week later. Care needs to be taken here, and the purchase should not be made until the stock price actually bounces off the 50-day average. If you entered the trade at the green arrow, slightly below the 50-day moving average would be your stop loss point. But if you waited to get in, then the blue arrow would have been the correct entry point. We had a nice price run up and a retracement a few weeks later when the stock moved down to the 50-day average and commenced to bounce off it again. This gave us a new buying opportunity. As the second volatility squeeze, the stock moved up and crossed the 50-day average again, and at the same time the volatility expansion started, shown at the black arrow. We now move to the current market situation where we have just finished a volatility squeeze and started our volatility expansion and breakout. We entered a new trade when this occurred, and with the small move the stock made up, we have achieved a very nice profit. Notice that the stock did not retrace back to the 50-day on this squeeze, but the stock price is basically moving in parallel with it. You could view this as a reason for caution, but with only 1 week to go for expiration, we are comfortable with this trade because we entered the position at the first indication that the expansion was beginning. Notice that the biggest price moves come with the volatility expansions, and the biggest moves occurred with the tightest or longest squeezes. The primary use for the 50-day average is an uptrending stock is to give us a support line that, if broken, may warrant an early exit from our position. It also generally gives us an absolute point for a conditional trade exit strategy on the way down or a buy point on the way up. I am now going to show six stocks and the results obtained to date when using these supplementary techniques after a new up move or a continued move, even though there was no new buy signal from the supply and demand charts. In the past, we may not have placed these trades because we might feel that the stock became overextended or was ready to make a long drawn out consolidation. The first stock is Hewlett Packard, which had a nice stock price move from $44.90 to $48.50. But using our techniques, we gained a 37% profit on this transaction. Our second stock is Teck Resources Limited, symbol TCK, which only moved up 91 cents, but we made 21.9% on its move after applying one of our many possible strategies, which are all taught in our CD course. Our third stock moved a mere 70 cents from our entry. We were a little late in getting in this one, but we still earned 20% on its small move. McDermott International, MDR, gave us a very large gain of 48% on a move of only 99 cents. On Manitowoc, we gained almost 21% from another small move. Borg Warner is set to give us our biggest gain in a few short days, a whopping 50%. All of these positions will close on Friday, September 18th, and we will show the results in an updated copy of this video and probably on our website. As you can see, these trades will give us a 33% profit on our investment capital, a return of $6,600 on a $20,000 investment. Nice, isn't it? If you invested in the stock, you would have made a nice 4.9% profit just buying the stocks with the same amount of cash, but your risk actually is lower using our techniques, as well as our gains being higher. It's important to notice here that our timing and buy signals gave us stocks that made money even without our advanced trading techniques. And our strategies made us a whole 32%. For the general public, go to our website to learn more about how we do investments and how you can learn to do them yourself each month. Take a look at our results for the year and think how your accounts would look if you had signed up in December of last year. For our clients, We hope that you see that we are always trying to improve our success rate and wish that we could accomplish 100% successful trades. Even though we have not had a losing month this year, we didn't like the few losses that did occur. Thank you for listening and good luck and happy trading.